Welcome to our live webinar today, Maximizing Schedule C Deductions. Definitely something that we all need as part of a refresher as we prepare for next year's tax season. So we've had a lot of success and a lot of engagement with this topic. So we're happy to have a redo of this session. This is the second time we're hosting it. And Anthony, thank you so much for being here. We appreciate you.
Thank you so much for having me, Luis. I'm looking forward to this presentation. I'm hoping that we can learn a lot and get our skills sharpened for this upcoming tax season. My name is Anthony Sampson. I'm a solution architect at Wolters Kluwer, just like Luis was talking about, and a little bit about that as well too. I've got about 10 years of tax and accounting experience working under my belt, working for various different firms throughout the metropolitan Atlanta area. And just tell you a bit, I am a practicing EA, just like Luis told me, and I work with many of our Wolters Kluwer tax and accounting solutions. We're actually going to have a couple polling questions that we're going to be kicking off on our presentation today. And before we do that, let's go ahead and get started with that actually, and talk about some of the things that we're going to talk about today. So we're going to make sure we go over strategies to maximize your client's tax refund. And that comes with when you're working with clients that have Schedule C, so whether they're a single member LLC return, or they're a sole proprietor, things of that nature. We're going to touch a little bit on the Qualified Business Income Deduction, QBI, and with our TaxWise product, it automatically calculates that for you. And we'll also touch on some things regarding mileage and actual expense. I know that's a hot topic that some clients would actually keep up with their mileage, and so many other clients would not keep up with their mileage. It'd be something that usually comes up time after time. We're also going to talk about utilizing our CCH Answer Connect product. So when you're having a research topic, because sometimes you don't have everything directly in front of you and you got to go through and do some research on specific items, we're going to go through what that process looks like to use CCH Answer Connect to help you to maximize your tax deductions. And we've got some practical examples. We'll be using our TaxWise Online solution on today's presentation. So Luis, let's go ahead and launch that first polling question here about the actual versus expense mileage deduction. Luis, we can go ahead and launch that. Let's kind of see what the crowd is going to say. Do they mostly use the actual expense deduction or the actual mileage method? Which one has the most bang for the buck there with your clients?
That's right, Anthony. And we see right now 73% of everybody answering mileage, 27% actual expense. And Anthony, I think that's in line with what we saw during our previous session on the same topic.
Absolutely, absolutely. That's correct. That's correct. So just about same thing about the mileage method. Now the question is, I really should have had this polling question. Do your clients actually keep up with their miles throughout the year? That should have been the question. What percentage of your clients actually keep up with their miles reduction? Because that's a very rarity of clients having to keep up with that extra paperwork and things of that nature. I'm so glad that we have a lot of technology available with mobile apps and things of that nature that automatically tracks that. So great. So we got about 68% of you voted, and about 76% said mileage, about 24% said actual expense. So let's go through that today here in our presentation, and I'm going to pull up our TaxWise Online solution. Can everyone see my screen here on TaxWise Online?
We can see it. Yep.
Absolutely. Let's go ahead and give this client a birthday. Let's go ahead and give him a birthday 01/01/2000. He's a young guy. He's only about, what, 20 years old, all right? 19, 20 years old. So today on our presentation, we're going to walk through mainly on how to determine, should we take that actual expense mileage or should we take that actual mileage method. And I'm going to come in here and I'm going to add a Schedule C into the tax return. Just like that, very simple ability that in TaxWise Online. And for purposes of our presentation, we're going to skip some of this information about the business code and the business address and things of that nature. We're going to just kind of be more direct and straight to the point as we kind of go through this on our presentation. Now I'm going to come further down, and as I'm coming down in TaxWise Online, we have a section called car and truck expenses, and this is pretty much a mirror of exactly what the actual Schedule C looks like, that with that car and truck expenses. But now we've got our links over here, this little gray arrow. That gray arrow links us over there to the corresponding worksheet. And with that corresponding worksheet, we've got this section over here where we say the actual vehicle worksheet, business vehicle worksheet. And as we're adding in on the business vehicle worksheet, we can come in here and put details about this particular client and about the vehicle it drives. So let's say in this case scenario, we've got a client, and our client's name is Mr. Schedule C. That's our client's name today, Mr. Schedule C. And Mr. Schedule C just bought a brand new F-250. He said, no, I don't need an F-150. I need an F-250 for all the work that I do in my business. So this business is a 100% used for business. I'm going to go ahead and put this truck in here. And the business miles, let's say we've got about 18,670 business miles that we got in it, and this vehicle is used 100% for business, right? That F-250, that's not something that you want to go riding out with at night. It's a big gas guzzler. So we've got that F-250 that's used 100% for business. So he's going to provide his actual expenses over here. So we're going to put about, let's say about 1775 for gasoline is what he's purchased for the year. And oil changes, he had a couple oil changes, so we'll put about $300 in oil changes. For some tires, we're going to put about $500 for some tires on there. And then I've got some repairs that he's made to the vehicle, just some minor things he's had to done. So I'm going to put about $850 for those repairs. And then we've got, washing it. He likes to keep it clean and fresh and everything. So get an occasional detail a couple times throughout the year. It's about $200. And the whole purpose of me going through this is going through the actual expense. So for those 24% of individuals that actually voted actual expense, I'm going to show you how working with your clients can help them to be able to maximize your Schedule C deduction. In this case now when they're working with a vehicle. So we've got $200 for washing it and cleaning their vehicle. And insurance, let's say he's a good driver and he's got about $775 in insurance. And let's say that there's actually a note. Let's say there's a truck payment. Let's say that he actually has a truck payment. And so far for this particular year, for 2019 filing season, he had about, let's say, $470 in interest. So we're gonna go ahead and put that $470 in interest. Now, I'm in the state of Georgia, and there's something called a birthday tax. And a birthday tax, pretty much, I've just made it up, but that's what we call it. Every year, you've got to pay a fee for your tag or something like that for your ad valorem tax. So you pay that one fee. So I'm going to say $20 right there. So altogether, in actual expenses for operating his vehicle for 2019, he has about $4,890 in actual expenses, which is not bad. That's not bad. Okay, so if we take in the actual expense method, that's what he has for that brand new nice F-250. I'm saying that because I saw some F-250s at the park yesterday and they look really nice. But anyway, so we're coming back over here. So we're going to come back on over to the Schedule C. And let's say our same client, Mr. Schedule C, who's running his business and using his truck. I'm going to come down to the actual, matter of fact, I'm going to come down to the second page of that Schedule C. And on the second page of that Schedule C, let's say that same client, instead of him actually, that same 18,670 miles, we're going to go ahead and put that in there, 18,670 miles. Now, you want to make sure your clients are keeping some documentation, and we've actually got a link. Louise, I'm going to go ahead and put that link. If you could put that link in the chat, Louise, for the mileage log, and that's something that you can supply to your clients if they're not keeping up with their miles. I'm going to go ahead and check the box over here, and TaxWise automatically calculates what the mileage is. So let's say, when did you place that vehicle in service? I'm just going to put 01/01/2019 to keep it simple. And look at that right there. We've got $10,829. And how did we get that as a deduction? Well, TaxWise automatically calculates what the actual mileage deduction is, because we already have the 2019 mileage rate built into the software. So you see that 58 cents a mile. So the total deduction is $10,820. So that's the actual expense deduction the client would take on their return. So I come back on over to our vehicle worksheet, and we had $4,890. So let's think about this for 1 second. I'm going to pull out my handy dandy calculator, and let's take a moment here and think about this. When we took the actual expense method, we had $4,890. Okay. All right, 4,800. That's pretty good. All right, he brought in all his receipts, his gas receipts, everything like that. It's pretty good. Interest on the truck, car insurance, everything like that, vehicle insurance. When we come over to the mileage method, we're looking at about approximately $10,829. So with that being said, I'm going to come over here and subtract that $10,829. That's $5,939 increase in a deduction. That's a significant increase. And if we were to divide that 59.30, that's almost about you could say about 40% or so, a 40% increase in deduction. So it's clear to see that the actual mileage method is a good approach to use. Now, there's a template over here, a mileage log template that's free. You could just Google it. Microsoft provides one to you. It's like a little mileage log. It's in an Excel spreadsheet, and you keep up with the miles. Now, you're probably saying to yourself, okay, well, what if I've got a client that didn't keep up with their mileage? What am I going to do? Am I going to estimate it? Well, the IRS does allow for estimates in the event that you cannot produce those records for the clients Circle 230. One of the things I would recommend that you do when working with your clients is, and you're having to kind of estimate certain things, track, okay, how long are they going to each job? And I've got some clients where they keep their jobs in their calendars, the places they're going, things they're doing, they got on their calendar, or what jobs they've done, things of that nature. You can go back and create that. You can have the client go and create that mileage log based off the jobs they went through throughout the year and track that actual mileage approach. So good question, good question. Those are some good ideas that are coming up. Now we're gonna go a little bit deeper, okay? We're gonna go a little bit deeper. So Luis, I want us to launch our next polling question. This is something pretty interesting that's gonna come up here next in our next polling question. Go ahead, Luis.
Absolutely. So the next polling question is depreciation included in the mileage method? So the options are yes or no.
All right, Luis. So let's see. Let me go back to that polling results. What came back in as the polling results?
So we had 56% with no, depreciation is not included in the mileage method, and then 44% with yes, depreciation is included in the mileage method.
Okay, all right. So 56% said no. All right. So everyone get ready to be impressed. Now, if you had asked me this question, if I was sitting on a webinar and this question came up, maybe 2, 3 months ago, I wouldn't have known. You know what I had to do? I had to use our product, CCH Answer Connect, and I actually took a webinar. So we've got a lot of webinars that give you CPE, continuing professional education, and I sat on a webinar on our CCH CPE link, and it explained it clearly to me that depreciation is included in the mileage method. So 56% of people that said no, you just learned something brand new today, okay? That whenever you are actually using the mileage method with your clients, and as of 2019, 26 cents per mile, 26 cents per mile is part of depreciation. There's a reason why I'm bringing this up. And for 2020, it's going to be 27 cents a mile. So what's the reason why I'm bringing it up? Well, the reason why I'm bringing this up is when that client decides to sell that F-250, right? Maybe he got bored, maybe he got tired of it, maybe he bought the F-250 and his spouse didn't know he bought it. I'm just kidding. I've had situations like that before. But anyway, maybe he has to get rid of that F-250 and he says, you know what? I'm going to go ahead and get rid of this F-250. There's going to be some recapture of depreciation. A recapture of depreciation meaning that there's a possibility there could be a profit, a gain on it. Because if you've been depreciating this asset year after year, and with all these kind of depreciation rules we have, such as bonus depreciation, things of that nature, you've been depreciating this asset with every single mile they drove. That client got 26 cents per mile, and for 2020, they got 27 cents per mile. And let's say they drove a good amount of miles in that particular year. When that client decides to go and sell that vehicle, there is going to be a recapture of it, and there may be a possibly be a gain on the sale of that asset. So you want to make sure as you're sitting with your clients, especially now, we've got what, 10 more days. Oh my goodness, there's 10 more days left for the filing season. As you're sitting down with your clients over the next 10 days, and even going forward into the upcoming tax seasons, making sure you have these tax planning kind of conversations with the clients, like do you intend to dispose of your assets, sell your vehicle, or upgrade your vehicle, or trade it in? Have that question because there's some tax planning tips available. And as everyone knows, when you do some tax planning, what does tax planning turn into? Revenue for your business and more satisfied and happier clients because you're sitting down with that client planning out things for that client. All right. So if you want to learn more about the depreciation that's included in the actual mileage method, definitely log on to our CCH CPE link. We actually have a webinar on CCH CPE link that you can get a CPE for and learn more about the depreciation that's included in the mileage method. All right. All right, so let's move on to our next topic, and this is actually a hot topic. I'm very excited to introduce this simplified method versus the actual expense method for the home office deduction. And let's kind of talk about that simplified method versus the actual home office deduction. And as we're going through this right over here, I want to make sure we really address this in further detail. And there's a reason why, because I remember, and I'll tell you a little bit, I started out working, preparing taxes at Jackson Hewitt Tax Service, right? And I used to work there when I was in college. It's a seasonal job. And one of the things that I used to hear from some clients, they used to say, "Oh no, I don't put the home office deduction." That's what they used to say. Don't put the home office deduction on my return. I'm scared I'm going to get audited. And me, fresh out of tax school or Jackson Hewitt training, I used to say, why? I mean, if you're running a business at your home, it's a legitimate deduction. But then after working with clients and working in the industry year after year after year, I'm starting to understand why a lot of folks make mistakes, especially those TurboTax users. When they're using TurboTax, they make a lot of mistakes when they try to do their taxes on their own instead of hiring people like you, professionals, to do their taxes. So we're going to walk through some of the ways to maximize your client's deductions or maximize your client's refund utilizing the home office deduction with the actual Schedule C. So let's bring up Mr. Schedule C back over here. All right. And we're looking at Mr. Schedule C on his Schedule C. And what I'm going to do, I'm going to come in here and add in some income on this return. So I've got no income on the return. I just got a big deduction of $15,719, but I got no income on this return. So I've got a loss on this return. So I'm going to put in that this client made $100,000, right? We've got the nice $100,000 on here. So we've got a profit now. We've got a profit of about, matter of fact, I'll keep it small. Let's keep the number smaller. Let's put in that the client made $30,000. Client made $30,000 in their business, so we've got a profit of $14,281 in the return. Now, there's some way, some of you folks like to use a simplified method. So you've got the simplified method as an option to utilize that. And with the simplified method, let's kind of take a look at this here for 1 second. And this is also showing you the automation that's inside our TaxWise solution. So simplified method allows you to take $5 per square foot. So enter the total square footage of your home. So let's say this client, let's say they've got about what, 2,500 square footage, right, in their home, right? That's typical 4-bedroom, 2-bath, about 2,500 or so, right? Just estimate. I'm not a home builder, I'm just estimating 2,500 square footage. And let's say, okay, I'm going to show you something. I'm going to show you the automation inside of TaxWise Online. So look what happens when I put 1 square foot. Look what happens right over there. It turns to 5, right? So, and I'm going to pull up this actual item over here. I'm going to show you when you use our CCH Answer Connect product. And let's kind of pull this up here. And what we're looking at right now, we're looking at the simplified method, also known as the safe harbor method. So on our CCH Answer Connect product, it explains the IRS may adjust the $5 rate from time to time, but it is $5 per allowable square footage to the home office. So when you use a simplified approach or safe harbor approach, that's what you're getting. So TaxWise has that automation automatically built in. So if I got 1 square foot, so I'm going to turn it to 2. Now it's going up to 10. Keep saying it and change that to 3. As you can see, vice versa, it keeps going up, keeps going up. The deduction keeps going up. The net profit keeps decreasing. We're taking a simplified approach. Now we can max that out at 900 square feet. Right, so we've maxed it out at 900 square. That's the most you can take. So on a simplified approach, 1,500 square feet. Now, when should be a good time we use a simplified approach? I'll give you a good example. I was doing a client's return one time, and she was actually living in New York City. That's actually where I'm from. She was living in New York City in Brooklyn, right? And she had some roommates, and she was renting an apartment. But she did some work from home. She was a self-employed person working from the home of the apartment that she's renting. That's a perfect example, because the utility bill is split between 2 other girls. I mean, everything is split. There's so many things that are going on to kind of figure out what's her share of the expenses, but get the square footage of her room and other parts of that apartment that she may be using for the actual produce her income. I think she was like a photographer, public relations. She did a lot of self-employed things, and that's a great example to use a simplified approach. Someone who maybe has an apartment, things of that nature, things are going on, very simple, straightforward. Let's go ahead and use a simplified approach. Now, there's some times when we should not use a simplified approach. So when should we not use simplified approach? I wish we were all live. If we were live, I would ask you to raise your hand. I'd be a little bit more active. That's why we got the polling question, but I wish we were all live. Soon, we'll be live soon. At some point in time, we will be live. But let's think about this now. When should we not use simplified methods? So we said Mr. Schedule C made $30,000 in his business, right? And Mr. Schedule C made gross sales of $30,000, and we've got a $1,500 deduction, and as you can see, we got a profit. Now, what if Mr. Schedule C had a bad year? Well, let's say he had a bad year, and he only made $2,000 in his business. So he made $2,000 in his business. He's working his business from home. What happened to our deduction? Where'd it go? It went bye-bye, right? The reason why our deduction is not here is because simplified method does not allow for carryovers. You must have a profit, a net profit on that actual Schedule C in order to be able to actually take the home office deduction when you use a simplified method, also known as the safe harbor. Okay, so what do we do next? What's the next thing that we're actually going to do? We're going to go ahead and use our 8829. That's when our 8829 comes in. So I'm going to put back that Mr. Schedule C made. Matter of fact, I'll leave it there for right now. Let's add in our 8829. So I'm going to go ahead and hit the plus sign. Let's bring in the 8829. And let's add in our 8829 to our Schedule C, to Mr. Schedule C's business. Now, let's go back to our same scenario. Let's say you've got 900 square area, 900 square feet, and the total home 2,500 square feet. So approximately about 36% of the home. So let's say Mr. Schedule C, he has a house, and with his house, he's using his garage to keep some product. Mr. Schedule C has some product stored in the garage, and he's also has an office in his basement, things of that nature. So he's got a lot going on in his basement. So we're looking at this, and I see the question coming in. Someone's asking, how does this change when someone has a mortgage? We got you. I've got that answer coming. I've got a big analysis about when they've got a mortgage coming in here. I'm going to really break this down. All right, someone's saying, Luis, can you see my screen? Everyone, can you see my screen? I think one person saying they can't see it. Can everyone see my
Yeah,
screen?
we can see it, Anthony. So we'll see. I'm trying to troubleshoot her.
Okay, all right,
But no,
no
we can
problem.
see your screen just fine. Yes, sir.
All right, perfect, wonderful. All right, so we're on the 8829, and as we're looking at the 8829, let's look at this. Now, this is the part. Remember that story I told you before when the clients used to say, "No, don't use the home office deduction, don't use it." This is the part where I think where a lot of those people working at home, I mean, doing their what do you call it, the TurboTax and do-it-yourself DIY tax preparation. This is the part where I believe they got in trouble because they would say, oh, okay, this is my expenses, this is my property taxes, this is my rent. They'll just come down on this direct side. But there's a reason when you use the actual direct side. And let's talk about this for a moment, the direct side. So I had a client a couple of years ago. He actually, in his backyard, he paid a couple contractors and they built him an office. They built an attachment to his home. They built him an office. It was really, really nice. He spent I think about $15,000, something like that, to build it. And we're going to talk about how to report that $15,000 properly. But that's where the direct side comes in, when you've got direct expenses related directly to this specific area. That's one example of where those direct expenses come in. Now, another thing that we're going to walk through this. So on the indirect side, let's talk about this. Casualty losses. If, let's say, we had unless that client lives in an area, where they've been declared a disaster zone by the federal government or something like that, you take the casualty losses. That's something you can do. Or if you had theft or something like that, because the casualty losses are not necessarily limited to the disaster declarance on the Schedule A. So if somebody broke into their home or something like that, there's been some damage to their property, you've got your casualty loss that you can put on there. Now, deductible mortgage interest. Let's talk about this for a second. Deductible mortgage interest. Now, with the Tax Cuts and Jobs Act, right? Tax Cuts and Jobs Act, it's probably made many of your clients that are actually itemizing, that are not itemizing, taking the standard deduction, right? Because especially if you got a couple, a married couple, and I think it's like what, 24,200 or something like that. So a lot of folks now, a lot of clients are actually just taking a standard deduction, or especially someone head of household. I think it's like $18,000 or something like that is the head of household deduction. So a lot of individuals, their standard deductions exceeding what their charitable contributions, mortgage interest, and property taxes are. So if you find yourself in that position, which many of us are now finding ourselves in that position with a client, if you did not deduct the, all right, let's bring this back up on the screen. If you did not deduct their actual mortgage interest on the Schedule A, come over here and deduct the mortgage interest. Let's say they've got about $3,000 in mortgage interest, right? So if you didn't deduct the mortgage interest on the Schedule A, let's say they took the standard deduction, go ahead and take it over here. Same thing, property taxes, right? Let's put about $3,300 in property taxes. I just got my property tax bill in the mail the other day. All right, so property tax about $3,300. We've got that over there. Now let's come a little bit further down. Now you can use the excess real estate tax. Now let's talk about this for you folks that are up in the Northeast, right? Northeast or California. I mean, that's property taxes are really, really high in the Northeast, right? Or just in specific jurisdictions. If that client has already maxed out the $10,000, if they've already maxed out the $10,000 cap on property tax on personal tax that they can take on the Schedule A, the excess amount, right? Figure out what the excess amount is for real estate taxes and put it over here. Put that excess amount over here. Go ahead and you can go ahead and take that deduction over there. Okay, so let's say that the excess amount was, I don't know, let's gonna put $500 or something like that. Now, another thing that a lot of us overlook and clients don't typically remember this off the top of their head. What is their homeowners insurance? You know, they've got, you know, when you get the mortgage interest statement, the 1098, it has the interest and sometimes it has the real estate taxes and it may have a mortgage insurance premium, but that's a product that's coming directly from the mortgage company. They may have homeowners insurance with another company, which in most cases they do. So, you know, ask the client, you know, okay, I need you to find out, reach out to your your insurance broker and get the actual insurance amount. Get that information on what the insurance amount actually is. So when you get that information from your actual client, when you get that information from your actual client, you want to make sure that you get that amount. So I'm going to put in here, like I just got mine in the mail. All right, so let's put $1,800. Okay. Now, same thing if the client is renting. In many cases, clients that rent, they need to have renter's insurance, right? So get that renter's insurance amount from the client. So let's go on the extra mile. All right, so repairs and maintenance. Now let's talk about repairs and maintenance. This is a little funny story here. A few years ago, I'm in my home office. A few years ago, you know, I painted my home office and I put some new carpet down. And my wife was laughing at me because she didn't think I was going to finish it in time, but I actually finished it overnight. You want to go ahead if the client is actually has some direct expenses. So I've spent some money to fix up my office. I put that new carpet down, new paint, things that I bought to kind of fix up the home office. So you can go ahead and put for that repairs and maintenance the direct amount. That's directly related to this office. That paint that I purchased, I didn't paint other parts of the house. I just bought paint for this direct home office. That's something that you can use. Now, how about the maintenance for the upkeep of the property, the entire home? So you got $500 as a direct repair and maintenance, but the upkeep of the home, the landscaping, you know, you've got other things that you got to update and work on the house and things of that nature. So let's say you had about $1,500 in repairs on the home, right? So you see how I'm properly using this, the direct expense related to the office and then the entire property. Same thing too for the utilities. Now for those utilities, let's just say $2,500 for the year for utilities. Those are some direct things. Now, this item is coming up. What about other expenses? That's a good question. Other expenses. Now, I wish I was in a room with all. Would I put a bookshelf here, or would I put a table here, or would I put a printer here as other expense? Not necessarily. I would put that as a depreciable asset because that's an asset in the business, right? So it has to be other expenses directly related to performing the business that would go in this other section right over there. So clearly we've got about $2,200 now. We've got in allowable expenses. That's pretty good. That's pretty straightforward. That's pretty good that we've got over here. But this is definitely us taking advantage of using the direct expenses for repairs, knowing when we should use that. And then also to the same time, especially for you folks, if the client has maxed out their $10,000 property tax deduction, figure out how much of that is exceeding it. And the way you can do it, you just back out the real estate taxes and figure out when it hits a $10,000 threshold, then the excess amount over the $10,000, you want to come over here and put as real estate tax. That's essentially what you would do in this case scenario. All right. And then we talked about over here, if the client took the standard deduction, let's say they took that standard deduction, I'm going to go ahead and delete this excess uh, real estate taxes over here. But if the client took the standard deduction, then go ahead and deduct the mortgage interest. Go ahead and deduct the real estate taxes because you did not deduct it on the Schedule A. You didn't necessarily do that. All right. So we've got that right over there. So we got a total deduction about $2,268. Now, here's the part I want to launch the next polling question, Luis. Let's go ahead and launch the next polling question before we move to our next segment over there because we got our $2,200 as allowable expenses. Let's launch that. Go ahead, that next polling question.
Right. So the next polling question is, does anyone use this simplified method for calculating the home office deduction? And that's, of course, anyone in the crowd today. So from our attendees today, do you use the simplified method? That's option number one. Or do you not use the simplified method? That's option number two.
Wonderful. This is really good, Luis. All my time in practice in 10 years, I've never used a simplified method. I always went straight to the 80/20. So this is really great. So definitely about 78% of you voted. So about close to 80% of you actually voted. And this is interesting. And it looks like someone's asking, what is the difference between direct and indirect? So great question that's coming up, the difference between direct and indirect. And the difference between the direct and indirect is the direct are items directly related to that particular location. So for instance, I'm in my home office right now, and the example that I use is when I went out and bought the paint and I bought the carpet. The paint that I purchased just for this room, my home office, and that carpet that I put down, which I think needs some new carpet here pretty soon. The carpet that I put down, this is a direct expense. It didn't go to anywhere else in my home. I didn't use that paint for my living room or for my bathroom. I just got that paint for right here. So that would be considered direct expense. So that's why it's important that the client saves their receipts, takes pictures of the receipts, use a receipt app. I know my wife, she owns a small business and she takes a picture of every single receipt that she has because the direct expenses are related to that particular room, that designated area just for the home office. Um, does that better answer your question? Yes. All right. Wonderful. Wonderful. All right. So we've got our direct and we've got our indirect over there. Wonderful. So now let's talk about unlock. Oh, now before we unlock another maximizing deduction tool, let's go back to this example here for a second. So we've got the $2,268 that we've taken for these expenses. I want to come back to the Schedule C. On the Schedule C over here, we've got this loss that's coming through. Now, when we use a simplified method, losses can't go through. So for the 63% of you individuals that said yes, that you use simplified method, you want to consider using the more detailed method using Form 8829. And the reason why I say that, if the client has a loss on their return, if they've got a loss on their return, there's no carryover. So you're going to see something. I'm going to go ahead and clear these numbers out over here. When I clear those numbers out over there, I'm going to go ahead and give Mr. Schedule C another 0. Let's bump him up a little bit. Let's give Mr. Schedule C another 0. All right, so we just bumped him up a little bit. So now he has that profit that's rolling in over there. Now you can see the expense for business use of home on the 8829. You see these numbers rolling in. This is rolling in directly from the 8829. These expenses are coming in directly from the 8829. So as you can see, you get a higher deduction for your clients when you use the actual Form 8829. It's a higher deduction. But we're going to go a little bit step further. And if we had a situation where the client had a loss, let's say they spent more money in their business, they had more expenses than income, then this amount, this $4,281, it would roll over, it would carry over to next year's return. So you've got that carryover option. So, okay, if they had a bad year this year, especially you may have some clients that are going to have a bad year this year, definitely go ahead and make sure you take advantage of their carryovers. And one of the things I tell clients, side note, is one of the things we tell clients too, when you talk about client retention and retaining clients, carryovers can help retain a client, because when you inform the client, say, yeah, when you tell the client that next year you got a $4,281 deduction that's coming to you next year, it's going to be rolling over, and I've got that in my system and my tax software is keeping up with it. I'm using TaxWise keeps up with it. Client's gonna think, okay, he or she, Rosie's on top of this. Maria and Water, they're on top of this. They know what's going on in my business. I'm gonna come back to them because they've got all my carryovers, they got all my numbers, they got everything I need right there. So you also want to communicate to the client when there's carryovers. That's one thing I make sure I do. I communicate when there's carryovers, because it just helps with the retention, because they may want to come back to you because they know you've got some things set aside for them for the next filing season. All right, so let's come back to our 8829. And time is flying so fast. Wow, it's already 2:40. It's already 40 minutes into the presentation. Okay, so we've got our deductions over here, right? We got our allowable expense over here, the deduction. And the reason why this number went up is because I took out the simplified method. I had the simplified method in there. The reason why the numbers went up because I took out the simplified method. So that's why reduction $4,281.
Yes, sir.
All right, wonderful, wonderful. All right, so yeah, absolutely. So everyone, you're right. The 1099, it's the 1099 NEC. So there's no cancellation of debt. It's not a new existing compensation. So this will be the 1099. So instead of issuing those 1099s and putting everything in box 7, the IRS has figured out, hey, most of the 1099s are probably in non-employee compensation. Let's just make a form for non-employee compensation. So it's a little bit easier. A lot of preparers, I'm looking forward to it this year. Just getting one form 1099 NEC, it makes it a little bit simpler. Some other people are excited about it as well too, because it just makes it easier for them to be able to work through this. So definitely 1099 NEC is what you'll be issuing. And we've actually got a product here. If you're not familiar with our product, we have a product called our W2 1099 product that we do have here at Wolters Kluwer. So if you want to be able to electronically file these forms and you don't want to have to mail the pink and white or red and white paper to the IRS, we've got a software called W2 1099 that will allow you to electronically file these 1099 NECs directly electronically and not have to print out and mail it to the IRS. So definitely talk to your sales consultant about it, or Luis will give you some information on how to reach out to us to find out some more pricing about our 1099 software that we have here at Wolters Kluwer. All right, that was a good commercial break. So let's come back to our actual depreciation for our home, depreciation for our business. Now, many folks would stop right here. Many firms would stop right here. They would actually say, okay, you've got a $4,281 deduction for your business, but what's the next level? Let's take it to the next level. Especially, and I love that question that came up there. I think I saw somebody post it in the chat, especially with COVID-19. I mean, pretty much many individuals are working from home. What is the best thing to do? So since many individuals are working from home, there's something called a depreciation for your home deduction. And the way how it works is you come down to line 37 on the 8829. And on line 37, it's going to say enter the smaller of your home's adjusted basis or its fair market value. So what does that mean? What is the fair market value? Fair market value, definitely if you go online and you get a market report, see what the value of your home is, just the fair market value, you can get a good estimate of what the fair market value for your home is. That's one option, but it says enter the smaller. Remember, make sure you read smaller correctly. Sometimes people may enter the larger, but make sure you read the smaller. Now, here's the other option. What's the home's adjusted basis? So what is an adjusted basis? Adjusted basis is what you paid for the asset. So what the client paid for their home. So let's say they paid $200,000 for their home, but say they made some upgrades. Like I know me, I've made some upgrades. I've made some upgrades to my home. I've improved my basement to accommodate my kids more, so my kids can have a playroom. I've definitely done some things to my deck, and I've done a lot of things. So I've made some improvements to my home, right? So what the adjusted basis is what the client paid for the property, and this is when it comes to a residential property. All right, we're not talking about business assets that you're depreciating, equipment, things of that nature. We're talking about a residential property. So what they paid for the home plus the improvements they added to the home, because we don't depreciate personal residents that are used for personal items. We only depreciate business assets. But what we're about to do, we're about to take part of this personal residence and include it in as a business asset to depreciate. That's what we're about to do. This is just some really good technical things that we're about to do here. So the smaller of it, so let's say, for instance, that the basis, we're going to go with a number here, and I got on my notes here. Sorry about that. I've got my notes here. I hate to look scripted. All right, so let's say the adjusted basis for the home is about 250,000. Okay, so now the value of the land, the way you can get the value of the land to, well, I know for the state of Georgia, in the state of Georgia, you can go to the tax commissioner's website, and on the tax commissioner's website, they actually list, when you look up the property, they list the land value, what the land value was assessed at on the property. So you're gonna need to deduct that, right? Because you can get audited. This can trigger an audit if that client gets audited by the IRS and you did not deduct the land value. That the IRS can, they legally have the right to add that back in to the base of the property. So the value of the land, I'm just going to put in $25,000 as the value of the land. So now the basis in the building is $225,000. Now, what it's doing is it's looking at, okay, now how do we get to the business basis? Well, the way you got the business basis is the percentage. Let's come back over here. Remember we said at the top that 36% of this business is being used, 30%, sorry, 36% of this home is being used for business. So since 36% of this home is being used for business, I'm going to scoot down over here. And as I'm scooting down, that means 36% of $225,000 is $81,000. So now we're actually gonna, so $81,000, so 36% of this property can be considered a business asset. So now we're gonna depreciate this part of the residence. And this is a good tax deduction that you want to work with your clients. I'm going to go ahead and hit the arrow over here. And TaxWise has a depreciation module for the business use of your home. So don't just have a depreciation module for depreciating assets, but depreciating the business home, use of your home. So let's put the date the asset was placed in service. And I'm going to go ahead and put 01 2019. Now this is important. Many of you folks, now do you remember March 16th? March 16th is a big day. Let me just make sure. Is it March 16th? I think March 16th, 2020 was a big day. I think that was a day that many, U.S. citizens, American citizens, started their journey of working from home. Right, that was a date that many of us started working from home. It might have been earlier, it might have been after, but you want to put, so for many folks on the 2020 return, you would put that date that they declared themselves working from home. They said, well, I've been working home for my business since, since the shutdown, since the pandemic started. So you probably put March 16, 2020. All right, so TaxWise took in the cost of the property over here, what the depreciation amount is. Now we got to put in the method. Now we're going to go with straight line. Now here's the thing. This property now, even though it's a residential property, $81,000 of this property, $81,000 of this property is a depreciable asset, is now used for a business now. So since 36% of it is used for business, we're going to do a straight line depreciation, and we're going to do it over 39 years, not over 27 and a half years, because 27 and a half years is for residential rental, right? So even though it's a residential home, 36% of it is not being declared for a business. So we're going to use that mid-month convention. That's what's being used for the property. And if we made a mistake on our convention, please let us know. We definitely will get you the accurate amount, but I believe that's correct. So now look at this. We've got the depreciation for this year, $1,990, right? 1990, right? Remember the 90s? So $1,990 is the depreciation deduction for this property. Now, this is another reason why the client's going to want to stick with you, because you've got these carryovers rolling over year over year. You've got this client for the next 39 years. It's going to be rolling over. Now, let's come back to our 8829 for just a second. So we come back to our 8829. We've got our deductions over here from the business use of the home, right? Our indirect and our direct is $4,281. But then we've also got another $1,990, right? And look, we've got, here's our carryovers. Carryover of unallowed expenses to next year. So TaxWise is automatically calculating what that carryover is going to be. We're automatically calculating that information. And the excess amounts is already calculated information. But as you can see, $4,281 plus $1,990. So let's go ahead and add this up here for a second. So $4,281 plus $1,990. So that's $6,271 in just business use of home deduction that we legally are able to take on the return. Now, remember our simplified method? What's that thing called? Simplified method. Remember that, right? Simplified method, right? If we had taken the simplified method is only capped at $1,500. So automatically, we've increased the amount of tax deductions for this client by $4,771. Automatically, we've done that. So that's another almost $5,000 in tax deductions that we're unlocking in this return. Now, on average, some clients are in the 15% tax bracket. So let's figure out dollar for dollar. So I'm going to take this amount times 0.15. So we've increased their deduction so we've increased their actual refund by $716. So much we've increased their refund by $716. That makes a lot. That's a big difference, right? And if you want to look at it from that other perspective too, let's say 40, let's go add these numbers up again, 4281 plus 1990, right? So we added, and the way I got these numbers is our two numbers right here, that 4281 for the expenses for the home, 1990 for depreciation, 671. Let's subtract that from the simplified method, which is 1500. So that's how we got our difference of $4,771. That's how much we increased the amount of tax deductions. And that actually makes a significant increase. I can't even calculate the percentages on that. That's a ridiculous percentage. I didn't write down the original number, but that's definitely well over 30 to 40% of deduction that you're getting for the clients. So we come back to our Schedule C and we look at Mr. Schedule C. Oops, let's go back to the first page of Mr. Schedule C. And let's scoot down over here, right? So there's that 4281. We had some limitations that things that are going to be carried over to next year. what I'm going to do is I could actually increase that profit. If I wanted to, I could increase that profit. It could increase the sales and you'll see more of the deductions come in. But automatically, you've got the 4281 coming in, plus you've got the amount that's going to be carrying over to next year's tax return. So all in all, that's a great way to really maximize the deductions for your clients. And one of the ways I was able to capture this information is by definitely utilizing our CCH Answer Connect tools, be able to research these various different items that I need, utilizing Answer Connect exceptions for certain business use of or rental use or limitation deductions for such use for business use of the home. So a lot of these information was found in our CCH Answer Connect product. So definitely, if you want to learn more about these items, I didn't have to take any other webinars, which you can, but you don't have to. You can capture this information from utilizing our CCH Answer Connect, or if you want to take another webinar on our CCH CPE link. All right, so we've launched that item over there. So let's go ahead and launch our last polling question, and I'll answer some questions as you answer it. On average, what do you charge to prepare a tax return with a Schedule C? And this question is for you. This is definitely for everyone. Everyone, let's learn from each other, because some folks may charge, 1,900, some folks may charge 200, some folks may charge 5,000, some folks may charge 400. So let's kind of get a feel for the room on what people charge for that amount. And I'm going to answer some questions in here.
Just to see what everybody's charging. Right now, we see 43% between $201 and $299. Next up is 29% between $300 and $400. Number three is under 200, and then 3% of the attendees today over $500. That's a 1040 tax return with a Schedule C.
Absolutely. So those are some good results coming in. So only about 72% of you voted. So if everyone could vote, we definitely want to find out some more of what everyone has to say. So everyone could vote on this, because this is helping other people to determine, hey, I probably need to raise my prices. These are some things that I may take into consideration. So this is
Especially the
helping you.
21% under 200. If
Yeah,
48% of the attendees are saying between 200 and 299, that's not a big increase. If I'm charging, let's say 175, but really the majority is charging between 200 and 300, then that's doable. I can increase, by 50, $70. Shouldn't be a big deal.
absolutely. Good point. Good point, Louis. So let's go ahead and look at some of these questions here. So Sophia is asking, how do you deduct home utilities from your home office? Absolutely, Sophia. So that was what we did when you come back to your TaxWise solution. And on that 8829, Sophia, on the 8829, there's a section over here on the 8820 form 8829. Towards in the middle section, you'll see line 21 says utilities, and you'll put in the indirect side, unless they've got a separate meter for their home office. Yeah, but on the indirect side is where you put in the utilities, the annual amount, what they paid for the entire year. Now, what they paid for the month, make sure you're multiplying, so what they paid for the entire year on utilities. Client can provide that to you, Sophia. So good question. Let me take a couple more questions, and then we can put up the slide for tomorrow's event here, Luis. It looks like Liz is asking, contractors that drive far away for business over 100 miles, can they use meals deduction? Absolutely, absolutely. If your contractors are driving, if they're working, if they have to eat on the job, definitely you've got your business use deduction right over here. They'll go ahead and take the you put it as a 50% deduction. They'll take the mileage. I'm sorry, mileage. Excuse me. They'll take the meals as a deduction right over here. You enter that amount. As long as they keep up with their receipts, they can definitely do that. So good question. Another question is coming up from Juan. Juan is asking, if a customer has never taken home office deduction, can we file an amended return? Yes, you can go back and file an amended return. I believe you've got 3 tax years. So you've got 19, 18, and 17. Now let's talk about amended returns for 1 second. We've got exciting news that just came out last month. For 2019 amended returns, you can actually electronically file those 2019 amended returns in TaxWise Online. That's right. So if you've got a client, if you want to go back and look through some of your Schedule C clients and you realize that there was no home office deduction there, and you want to go and amend that return and get them some more money back, get them a higher refund or lower their tax liability, you can go ahead and amend that 2019, just 2019 1040X. You can do that directly in TaxWise Online and electronically file it to the IRS. So great question that came up over there. And yeah, I believe we answered all the questions. And yes, we'll be sending you a copy of that. So I'm going to go ahead and stop sharing, Luisa.
And what it is, preparing your tax business to move forward in 2021. We have a panel that will be discussing, top challenges in 2020 and how to move forward in 2021. So look forward to seeing everybody there tomorrow. I've added the link on the live chat for everybody to click it, and then you see a page also on this screen. So Anthony, thank you so much for another great session. I don't believe we have any more questions in the Q&A remaining, but we will stay here over the next few minutes answering any remaining questions in the chat. If you are a TaxWise customer and you'd like to learn more about TaxWise Online, perhaps you're using TaxWise Desktop today and you saw TaxWise Online in action and now want to move forward to the cloud, call your account manager. The number is 800-495-4626. And hopefully you were able to notice that your desktop solution looks very similar to the online. So everything is in the right place. Your forms tree is on the left-hand side. Your forms are on the right-hand side. Color coding, adding forms, everything is exactly where it needs to be. If you're not using TaxWise, there is a page on screen that you can visit to find out more about TaxWise Online. You can actually sign up for a free trial account so that you can test it out on your own. You can register for a live product demonstration if you'd like. You can also send me an email and I'm happy to schedule a phone call so we can talk about your needs, your challenges, and just discuss if we're a good fit for you. But in general, Anthony, thank you so much for great content. I hope that everybody liked what they saw in regard to TaxWise, but more importantly, I hope that everybody learned something new about Schedule C deductions that can help your taxpayer clients maximize their deductions and increase their refund next year. So with that, we'll stay here for the next couple of minutes in the Q&A. Thank you everybody for attending, and thank you, Anthony, once again for a great informative session for everybody. Bye-bye.
All right. Thank you, everyone. Thank you, Luis. Bye-bye.